Does a strong and powerful, successful history guarantee a strong and successful future? Does growing income and growing dividends, does that past history always predict future success? Today, I'm going to have a quick look at Texas Roadhouse that deals with those steaks in that Texas and that South. It deals with steak in Texas style and Southwestern style cuisine. A fantastic company. It's a large company. It's a well established company. It has a strong track record of dividend growth and dividend payments. What could possibly go wrong here? Stick with me till the end of the video to find out a few more of my thoughts on this matter. Okay, welcome back. One of the beautiful things about this platform is it has a fantastic ability to dig into particular companies and understand what is going on historically in the company, what is going on now in the company, as well as the analyst's anticipation about what may happen in the future for the company. So we can see here Texas Roadhouse. It has a little bit of data along the top here, and we can drag this across a little bit more information there. We can see here a price chart. I've got this set to 10 years, and we can switch this to all, and we can get a perspective here. We can get this perspective here, 2005 to 2010. It didn't really go anywhere. That was the global financial crisis. That's what we might expect. Along with many other stocks, so in the 2010 to 2020, it experienced a strong upward shift. And then, of course, the pandemic basically kneecapped this restaurant company along with other restaurant companies. And we saw strong recovery in prices after the pandemic. Now, in terms of what we've seen a price to earnings ratio here of about 23 times in the last 12 months. And that it would indicate that we're expecting some fairly strong growth. We can see the market cap is $6 billion. Total debt is quite low. But we've also seen that they basically had no debt up until the pandemic. And then they took on, it looks like, quite a bit of debt. They've got a reasonable amount of cash on hand. And again, we will have a quick look at what that means later on. Quickly down here, we can also get a very quick perspective on the analyst estimates. So the analysts are expecting in the next several years, this year about a 15% increase in sales, then 10%, then 8% in 2025, full financial year. Perhaps most importantly, though, the earnings per share, you'll see each time that the earnings per share are increasing more than the sales. And one of the big questions is how and why are they managing that? What I can do, and one of the key things here as well, is if we go down some of these other elements here in Koifin, it gives us these snapshot windows here so we can very quickly get a sense of what's going on. Now we can see here, for example, during the pandemic, there was a suspension of the dividend, but generally we can sort of see this dividend appears to have been increasing and has still been increasing post-dividend, in fact, quite strongly. We can see that the annualized growth over 10 years has been well into the double digits of increases here, so that's very powerful. Now, another useful box here, I think, to look at is obviously the 2% yield coupled with a 17% annualized dividend growth rate would be very attractive. There's no doubt about it. But we also need to look here down at the total shareholder yield. Now, that's got the dividend yield as the main component here. There's some of this buyback yield. We'll have a quick look at what that means later, as well as this debt paydown yield as well at 1%. So basically, what are they returning to us, the shareholder? And we get this sense here from this number. So the shareholder yield is both what they pay us directly in dividends, the value of the shares that they're buying back, which increases the value of our remaining shares, as well as paying down the debt, which increases ultimately the value of the company. Money essentially that increases the value of the company left over for us as a shareholder. So hence the shareholder yield is a way of getting around, for example, taking on huge amounts of debt to continue to pay dividends, and we'll look at that sort of issue later on as well. Now, in this window, we are looking at the earnings result versus the analyst estimates, and we can see visually a fairly sort of mixed bag. Generally, they do a reasonable job, I would say, of hitting the analyst estimates. One of the big issues here, obviously, is the pandemic, and a couple of times after the pandemic as well. But generally, the analysts are doing a fairly good job here assessing the earnings results. Now, when we come all the way down to the analyst estimates, so sales have been increasing over the last several years quite strongly. That's very easy to beat the 2020 because of the pandemic. And we can see here that into the future, 2023, 2025, sales are again expected to increase. Now, the price to sales ratio is expected to look a bit more favorable in several years as well. Scrolling down though, EPS adjusted is expected to be increasing. Now, my interpretation is sales are expected to increase, but obviously there's not a little bit of magic here in the EPS, but they're going to be needing to manage other parts of the business very effectively to gain the EPS gain. And I'm not 100% confident they'll be able to manage that and pull that off. Now, net debt is expected to increase a little bit in 2025, but still maintaining a reasonable level of debt here, I think. Now, free cash flow. They're able to increase this, I would say, a little bit, but not a huge amount. CapEx it looks like it's going to be held relatively constant at about 300 million. And I think for the restaurants here, these margins and ratio values here are also really important to begin to look at. So the gross margins here. Now, if you're ever wondering what these values are and what these figures mean, a very simple thing to do is you can Google this, or you can just often it has the little information symbol here. So the gross margin here is the total sales or revenues minus cost of goods sold divided by the total sales expressed as a percentage. And what we can see here is we can see in 2020, obviously not so good. Let's ignore that year. 2021, 2022, so 17%, 16%. And we can see these gross margins are expected by analysts to more or less be about the same, which is always, I think, a very good sign. More you ask for? Okay, so now down to the financial analysis, we've got a whole load of tabs here, which let us jump very quickly into particular issues. I'm here on solvency, so we can see obviously the total debt to equity, not unsurprisingly perhaps after the pandemic, they took on considerably more debt relative to the equity. And we can see before the pandemic they were doing very well, and now after the pandemic they've got a lot more debt. And that's something that they need to take into account, or we need to take into account as investors. Again, total liabilities to total assets, that has jumped up at the same time as well. Now, when we begin to think about this also in terms of the total debt to EBITDA, the debt to EBITDA is before the pandemic was very low, sort of 0.2, and now the debt to EBITDA is 1.4 times. So we're running here on a little bit more debt. Bankruptcy risk. Now again, the bankruptcy risk here from the Altman Z-score, this was looking quite, I would say, quite favourable here up until, again, 2020, and I think we've been seeing the Altman Z-score has changed quite considerably since the pandemic as well. In terms of cash flow, what we can see is they've been repurchasing the common stock quite strongly. So we are back on the CoiFin platform. Now, one of the beautiful things about the platform is it gives us the ability not only to access individual stock data, which I absolutely love, but much more importantly, in some cases, is also to access wider macroeconomic data. So here, for example, I have in purple here the retail sales. So this is for restaurants and other eating places. And we can see the change here. Obviously, with the pandemic, there was a massive decrease, and then we saw a massive rebound. Now, if I was to say, hey, look, overall, there's been that steady upwards trend that seems to be increasing in the recent years, we can say that they're doing well in terms of retail sales. Here in blue, I, though, have the harmonized index of consumer prices, so the restaurants and hotels. So what this can see and show is that even over the pandemic, in a more sort of smoothed out fashion, we can see that the consumer prices, the prices being charged have been going up quite a lot. And now, what does this mean? It means overall, I would say that restaurants are doing well, but what I don't have here is the ability to access a perspective on the costs. But what we do know from wider economic environmental surveys is that the costs of labour are going up. It's getting harder and harder to find people to do the work. And as a result, payments and pay has been going up quite a bit. And that adds a lot of pressure on a company's bottom line. Can history repeat itself? Can Texas Roadhouse continue to powerfully increase those dividend payments to their investors? Or is the changing circumstances, are the changing macroeconomic forces too powerful for them to overcome? Let me know what you think in the comments down below. Is this going to be a company that surges from strength to strength? Or are they going to fall foul to the overwhelming forces that are lined up against them, increasing costs and challenges that they are facing within the wider economic environment? Let me know down below, are you invested, and if not, why not?